So, the man who literally wrote the book on real estate deals is now watching his empire crumble in real time. It's honestly hard to believe we're even saying this, but Donald Trump's once celebrated property portfolio is hemorrhaging value at a rate that would make any bankruptcy attorney reach for their filing papers. For decades, Trump built his entire identity around being the ultimate deal maker, the real estate mogul who could turn a vacant lot into a golden tower with his name plastered across the top. But guess what? The numbers don't lie, and right now they're telling a story that contradicts everything the man has ever claimed about his business genius. This isn't just about some bad quarterly reports or a temporary market downturn. We're talking about properties sitting empty for 16 years, buildings generating less income than they owe in mortgage payments, and a financial pivot so dramatic it's like watching a real estate developer suddenly decide he'd rather be in the cryptocurrency business. And trust me, the implications of what's happening here stretch far beyond just one family's balance sheet. Let me fill you in on what's been happening behind the gilded curtains of the Trump Organization. So Donald Trump built his public image on real estate. From the moment he took over his father Fred's outer borough apartment business in the 1970s, he positioned himself as the bold developer who would conquer Manhattan and beyond. He put his name on towers, slapped it across casinos, and convinced millions of Americans that the Trump brand was synonymous with luxury and success. Whether it was the original Trump Tower on Fifth Avenue, the Trump International Hotel near the White House, or the sprawling golf courses from Scotland to Florida, he really cemented himself as the face of American real estate excess. The Apprentice turned him into a household name, and his constant refrain of under budget and ahead of schedule became a political rallying cry that millions of voters found compelling. But here's where the rubber meets the road. According to reporting from The Real Deal in July 2025, the Trump Organization's core real estate holdings have been struggling mightily behind the scenes. The portfolio's issues have forced a strategic pivot away from property development entirely toward brand licensing and cryptocurrency ventures. We're not talking about a company expanding into new markets while maintaining a thriving core business. We're talking about a real estate empire that's quietly admitting its buildings aren't cutting it anymore. Take 40 Wall Street, for example. Trump has long cited this 72-story landmark in Manhattan's financial district as one of his most successful investments. He bought it for just $1 million back in 1995. But Fitch Ratings reported in March 2025 that the building's annualized net operating income has fallen by 65% from where it was a decade ago. The property generates only 80% of the cash needed to pay its $10 million in annual debt service. In plain English, the building is losing money every single month, month after month, and this isn't happening in a vacuum. Major players like Warren Buffett have made their positions clear on real estate investing. At Berkshire Hathaway's annual shareholders meeting in May 2025, Buffett explained why he prefers stocks over real estate, saying there's just so much more opportunity in the security market. He noted that when you buy property, you're not making a passive investment, you're starting a business. When the Oracle of Omaha publicly distances himself from the asset class that Trump built his entire mythology around, that's the market speaking volumes about the fundamental challenges facing commercial real estate. And before we go any further, let's be real for a second. This isn't about political partisanship or taking sides. The numbers here come from credit rating agencies, court filings, and financial disclosures that anyone can access. These are facts that transcend party lines. Now, back to the matter at hand. Reports from around June 2025 revealed just how precarious the situation had become for the Trump Organization's flagship Manhattan property. According to Bloomberg, the Trump Organization paid off the roughly $114 million outstanding mortgage on 40 Wall Street that month, erasing one of the president's biggest debts. Now, on the surface, that might sound like good news, evidence of financial strength. But here's the kicker. They didn't refinance the loan because they couldn't find anyone willing to offer comparable terms. Prevailing interest rates for similar buildings were almost twice the level on the original Ladder Capital loan, which carried a favorable 3.67% rate. No bank would touch that refinancing at terms that made economic sense. So the Trump Organization was forced to use cash from other ventures, specifically cryptocurrency and international licensing deals, to pay off a building that couldn't sustain itself on its own merits. Talk about robbing Peter to pay Paul. Essentially, we're looking at a real estate company that's being kept afloat not by its real estate, but by memcoin sales and deals with Saudi Arabian developers. According to blockchain analysis firm Chainalysis, those memcoin ventures alone generated $320 million in fees. World Liberty Financial, the family's cryptocurrency partnership, has produced coins worth at least $236 million more. That's over $500 million from crypto funding what's supposed to be a real estate business. And this wasn't happening behind closed doors where nobody could see it. The financial distress was visible to anyone paying attention to the commercial real estate market. Fitch Ratings downgraded 40 Wall Street's credit rating in August 2023 and then again in March 2025. By mid-2025, 1/4 of the building had been vacant for a full year, and annual income was $2 million less than mortgage payments required. If Donald Trump, the big guy himself who built his entire identity on real estate success, couldn't keep his flagship Manhattan Tower profitable during his second presidency, what does that mean for every other property in the portfolio scrambling to stay solvent? What does it say about the entire mythology? Now, this isn't the first time we've seen this pattern of struggles across Trump properties. The Trump Organization's real estate difficulties extend across multiple properties, multiple cities, and multiple decades of questionable business decisions. We've spotted this pattern time and time again. Just think about Trump Tower itself, the crown jewel at 725 Fifth Avenue that launched the entire brand. According to Wikipedia and Crane's New York business reporting from early 2024, Gucci is now the only major retailer remaining in what was once a bustling luxury mall with nearly 60 high-end stores. The escalators to upper retail levels are roped off and gathering dust. Wells Fargo placed the tower on a debt watch list in September 2021 because average occupancy had fallen to 78, 9% from 85, 9% at the end of 2020. And the average per square foot cost of condominiums in the building nearly halved between 2013 and early 2024, attributed to competition from newer towers, the age of the building, and the protests that regularly occurred outside. Then there's Trump International Hotel and Tower in Chicago, the 92-story riverside skyscraper that was supposed to cement Trump's presence in the Midwest. According to Block Club Chicago's reporting from August 2025, the 70,000 square foot retail space at the base of that tower has been vacant for 16 years straight. That's not a typo. 16 years without a single commercial tenant, making it the longest-running downtown retail vacancy over 5,000 square feet in the entire city of Chicago. 4 different brokerage teams have tried and failed to lease the space since the building opened in 2009. And let's not forget the Doral Resort in Miami, one of Trump's most visible properties. Forbes reported that Trump was forced to refinance that property in May 2022 after the pandemic devastated luxury hospitality. With a value of $273 million and debt of $125 million, he has just $149 million in equity remaining. The pandemic hit luxury properties hard, and the Trump brand didn't provide any special immunity from market forces. Even the international licensing deals that were supposed to represent the future of the business tell a troubling story about the core model. Since securing the Republican nomination for the 2024 presidential ballot, the Trumps announced 9 international licensing agreements, 1 each in Vietnam and Serbia, 2 in India, 1 in Qatar, 1 in Jeddah, 1 in Dubai, and 2 in Riyadh. But licensing deals don't build buildings. They just rent out a name that in some markets has become more liability than asset. Now it looks like the entire portfolio is in the hot seat. This pattern is becoming all too familiar. You can slap your name on every surface, claim billions in net worth on financial statements, and market yourself as the greatest deal maker in history. But the moment the market stops cooperating and the buildings stop generating cash, reality catches up with even the most carefully constructed mythology. Here's where it gets interesting. So, what exactly went wrong with this empire? Well, it all boils down to a classic real estate paradox that the Trump Organization has never been able to escape. The impasse happened because the Trump brand, which was supposed to be the organization's greatest asset and competitive advantage, has become both a blessing and a curse in the modern market. In heavily Democratic cities like New York and Chicago, the political stigma actively drives away potential tenants and buyers who don't want their business associated with controversy. But in friendly markets where the brand might be an asset, the name alone can't overcome fundamental market dynamics like rising interest rates, massive office space oversupply, and dramatically changing consumer behavior since the pandemic. As the managing entity, the Trump Organization decided to take an aggressive approach to valuation and leverage that eventually caught up with them. According to court filings in the New York civil fraud case, Trump's statements of financial condition between 2014 and 2020 overvalued his assets by between $812 million and $2.2 billion. Judge Arthur Engoron found in February 2024 that these inflated valuations were used to secure favorable loans, saving the organization approximately $250 million in interest over an 11-year period. At first, that approach seemed to work brilliantly. Banks like Deutsche Bank extended generous credit lines based on Trump's stated net worth. The properties looked healthy on paper, even when reality told a different story to anyone who walked through the empty retail spaces. But as the properties aged, as tenants fled to newer buildings, as the pandemic fundamentally transformed office work, and as post-2020 inflation pushed interest rates to levels not seen in decades, some serious issues started cropping up that couldn't be papered over. Occupancy rates dropped across the portfolio, rental income declined precipitously, and debt service coverage ratios fell below 1, meaning buildings were bringing in less than they owed to creditors each month. The New York Attorney General's investigation found that 40 Wall Street was valued at $524 million on Trump's 2011 financial statement, while actual professional appraisals placed it at just $200 million. That's a gap of over $300 million that eventually catches up with you. This is the moment when the house of cards starts to wobble. You see, the Trump Organization values its brand above all else, treats the name as the core asset. But the brand can't pay mortgage bills. The brand can't fill vacant retail space when brokers say the Trump sign becomes a liability. The brand can't convince institutional investors to refinance debt at favorable rates when credit ratings are being downgraded quarter after quarter. And then came the pivot that, according to critics, represents a fundamental admission that the real estate model isn't working anymore. The cryptocurrency ventures, the meme coin sales, the licensing deals that require minimal capital investment. These aren't expansions of a thriving real estate empire diversifying into new opportunities. They're lifelines thrown to a drowning portfolio, emergency measures to generate the cash that the buildings themselves can no longer produce. Let's break this down further. Now, this leaves the Trump Organization in an incredibly tight spot with no easy way out. On one side, the family needs to maintain the image of wealth and business success that has been central to the Trump brand for 50 years. Any public admission of financial struggle contradicts decades of carefully cultivated positioning. The base of supporters who view Trump as a business genius would be deeply shaken by evidence that his buildings are bleeding money. On the flip side, the organization actually has to keep operating these properties on a day-to-day basis, pay the debts coming due, and find tenants in markets that aren't exactly welcoming the Trump name with open arms. That means making hard decisions about selling assets at losses, taking on expensive refinancing that eats into margins, or continuing to use cryptocurrency profits to subsidize underperforming real estate indefinitely. The tricky part is that both approaches carry enormous risk. The organization can keep holding on to properties, hoping for a market turnaround that may never come given structural changes in how Americans work and shop. But that means continuing to lose money on buildings like 40 Wall Street and the Chicago Tower, watching equity erode as maintenance costs rise and ground lease payments balloon. According to Fitch, the ground rent on 40 Wall Street is set to jump from $2 $3 million annually to $6 million when the lease resets in 2033. That's a fourfold increase that could fundamentally alter the economics of ownership and potentially push the property into bankruptcy. Or the organization can sell properties at what would almost certainly be distressed prices in this market, crystallizing losses and publicly acknowledging that the emperor's portfolio isn't worth what he claimed. Forbes reported in April 2024 that 40 Wall Street's value had fallen to just $47 million, down from $90 million the year before, and far, far below the $500+ million Trump claimed on financial statements. Imagine selling a building for $47 million that you claimed was worth over $500 million. That's the kind of headline nobody wants. It's a tough situation, and that's the mess that decades of aggressive valuation and leveraged expansion created. The strategy that built the empire is now threatening to bring it down. The same bold approach that generated headlines and attracted investors is now generating credit downgrades and special servicer involvement. This whole scenario is causing major stress within the broader Trump business ecosystem. If the flagship properties in New York and Chicago can't find tenants and generate positive cash flow, every other Trump-branded property around the world is left wondering if they're next. The international licensees in Saudi Arabia, India, and the UAE are watching closely to see whether the name still carries cachet that justifies premium pricing, or whether they've attached themselves to a declining brand that may become a liability. Those moderate observers who followed Trump's business career for decades are increasingly skeptical about the future. Real estate analyst commentary cited by the New York Times points to a fundamental pivot away from actual property development. The Trump organization hasn't built a major new property from the ground up in years. The development pipeline is essentially empty. Instead of construction cranes, we see cryptocurrency launches. Meanwhile, the cryptocurrency and licensing ventures that are generating cash carry their own substantial risks. Meme coins are notoriously volatile, subject to dramatic crashes that can wipe out value overnight. International licensing deals in regions like Saudi Arabia come with political and reputational considerations that could shift dramatically based on geopolitical events entirely outside the organization's control. These aren't stable, long-term income streams that can support a portfolio of aging buildings. They're high-risk bets that happen to be paying off at the moment, but could reverse just as quickly. Things became even more intense when financial analysts began publicly questioning whether the traditional real estate business model was viable for the organization at all going forward. When even conservative financial publications and credit rating agencies start using words like distressed and negative cash flow to describe Trump properties, you know something fundamental has shifted in how the market perceives the business. Now here's the kicker. The legal landscape adds another layer of complexity to this already precarious financial situation. New York Attorney General Letitia James brought a civil fraud case against Trump, his sons Donald Jr. and Eric, and the Trump Organization that went to trial in late 2023. In February 2024, Judge Arthur Engoron ruled that Trump was liable for persistent business fraud, finding that he had submitted blatantly false financial data to borrow more and at lower rates. The judge ordered a penalty of over $454 million, which grew to over $500 million with interest accruing. The legal process actually moved relatively quickly given the complexity of the case, and the appeals court recognized both the seriousness of the findings and some concerns about the proportionality of the penalty. And let me tell you, the appellate court didn't hold back with its analysis. In August 2025, the New York Appellate Division's First Department ruled on the appeal in a 323-page opinion. The five-judge panel agreed that the $500 million penalty violated the Eighth Amendment's prohibition on excessive fines and threw out the monetary judgment. But here's what's crucial to understand. The court affirmed the finding that Trump and his organization were liable for fraud. Two justices, Diane Renwick and Peter Moulton, fully supported the fraud finding. Two others, John Higgett and Lynette Rosado, thought the record had problems and would have sent the case back for a new trial, but they signed on to the judgment anyway to allow the case to reach New York's highest court for final resolution. Only one justice, David Friedman, said the case shouldn't have been brought at all. So while Trump escaped the massive financial penalty, the legal finding that he engaged in persistent fraud stands as the law of the case. Attorney General James filed a notice of appeal in September 2025, signaling she'll ask the Court of Appeals to reinstate the penalty. This legal battle isn't over by a long shot. The court also maintained business restrictions on Trump, including court-appointed monitoring of his operations going forward. That's significant. It means independent eyes are watching how the Trump Organization conducts business, ensuring the practices that led to the fraud finding can't simply continue unchecked while legal appeals work through the system. Legal and financial experts are noting that we haven't seen this kind of sustained scrutiny of a sitting president's business operations since Watergate, and even then the focus was on political rather than commercial conduct. Jessica Roth, a former federal prosecutor who appeared on PBS NewsHour following the appellate ruling, noted that despite the penalty being vacated, the effect of the decision is to affirm the judgment, the verdict against Trump, his sons, their business associates, and their businesses, finding them liable under New York's civil fraud law of engaging in persistent fraud. Just think about that for a moment. A sitting president's family business has been found liable for persistent fraud by a state court, and that finding survived appeal. And this is coming from mainstream legal analysis, not partisan commentary. Warren Buffett, speaking at the Berkshire Hathaway annual meeting in May 2025, didn't directly address Trump, but his comments about real estate investing landed with particular resonance in this context. He noted that real estate deals involve negotiations that just begin when you agree on deals and then they take forever. For a 94-year-old investor planning his retirement, he said, "It's not the most interesting thing to get involved in something where the negotiations could take years." When the most successful investor in American history is publicly explaining why he prefers stocks over real estate, and when that explanation highlights the complexity, illiquidity, and management burden of property ownership, it's hard not to see a broader market judgment on the asset class that Trump built his entire identity around. The Oracle of Omaha sees more opportunity in securities than in bricks and mortar. That's a message worth hearing. So let's break down what this showdown between image and reality could mean, because it's not just a captivating business story. It has serious consequences for how we think about wealth, politics, and accountability in America. First up is the immediate political fallout. Trump has built his political brand around being a successful businessman who can apply deal-making skills to government. The persistent stories about struggling properties, fraud findings, and the pivot away from actual real estate development fundamentally undercut that narrative. Democrats are definitely planning to take advantage of this situation. They'll argue that Trump's business acumen was always more marketing than substance, that the man who couldn't keep luxury retail tenants in his flagship tower for 16 years probably shouldn't be trusted with economic policy decisions affecting millions of Americans. They'll have court filings and credit agency downgrades to back up those claims. You can expect to see references to the fraud finding, the property vacancies, and the cryptocurrency pivot popping up in opposition research, campaign ads, and debates for years to come. This is going to be Exhibit A in the argument that the emperor has no clothes, that the brand was always more powerful than the underlying reality. Now let's touch on what this means for the institutions involved. The New York court system has taken an extraordinary step in maintaining monitoring of a sitting president's business operations. That's unprecedented in modern American history. Whether you view it as appropriate accountability or political overreach depends largely on your political perspective, but the institutional precedent being set is significant regardless of how you feel about Trump personally. The banking and credit rating institutions have also played a notable role. Fitch, Wells Fargo, and other financial entities didn't hesitate to downgrade Trump properties or place loans on watch lists despite the potential political heat. That suggests the financial system's risk assessment mechanisms still function independently of political considerations, at least to some degree. The numbers are the numbers. This situation shines a massive spotlight on the intersection of business interests and political power. At the heart of the issue is whether a president can operate a complex business empire while holding the highest office in the land without conflicts of interest corrupting both roles. The continued monitoring, the ongoing appeals, and the public documentation of financial struggles all suggest that question remains very much open and unresolved. So, the implications of this situation reach far beyond just the Trump organization. It's about shaping expectations for wealthy political figures for many years to come. Each time the gap between claimed valuations and actual market performance becomes public knowledge, it normalizes scrutiny that used to be considered inappropriate for successful business people. Future candidates who tout their business success will face more skeptical examination of their actual track records. Journalists and opposition researchers now have a template for digging into financial statements and comparing them to independent valuations. Think about it. If a former president's properties can be shown to have generated negative cash flow while he claimed billions in net worth, what does that mean for the next wealthy candidate who runs on business credentials? The precedent being set here is that claimed success will face actual verification against independent evidence. Looking ahead to future elections, it's clear that all of this is going to have significant effects on political discourse. The narrative being set now of a real estate empire that's quietly pivoting away from actual real estate while buildings sit empty and credit ratings get downgraded fundamentally contradicts the story Trump has told about himself for 50 years. Voters may or may not care about property vacancy rates in Manhattan or Chicago, but the broader story of image versus reality, of claimed billions versus actual financial performance, of a dealmaker who couldn't get a deal done on retail space for 16 straight years, that story has legs. That narrative resonates far beyond real estate industry observers. So here's the deal. The man who built his entire public identity on real estate success is watching that empire struggle in ways that can no longer be hidden behind marketing and bravado. This isn't just about property values or vacancy rates or credit downgrades. It's about whether the narrative that powered a political movement and shaped American politics for a decade was ever grounded in reality. If the flagship properties keep hemorrhaging money while cryptocurrency ventures and international licensing deals become the actual profit centers, then we're basically acknowledging that the real estate mogul story was always more brand than substance. That would mean the foundation of the Trump political phenomenon rested on something closer to mythology than actual business achievement. It's about so much more than just buildings and balance sheets. It's about whether Americans can trust the images that wealthy and powerful people project, or whether we need institutional mechanisms like the court-appointed monitors now watching the Trump organization to verify claims against reality. So, keep an eye on this. Things are just heating up. The appeal of the fraud penalty is heading to New York's highest court.